All right, listen. Something major just happened in the silver market. Silver is sitting around 77.69 right now, and in the last 24 hours, it's up about 9.7%. That is not a normal day. That's the kind of move that makes both bulls and bears feel sick because it usually means somebody got forced out and the market is still trying to figure out where the real price is. And it's not just silver. Gold is around 49.66, up about 4% in the same window. So if you're watching this thinking, okay, metals are ripping, I missed it, slow down. Because what you're seeing right now is not a clean rally. This is a whipsaw market. And whipsaw markets are where people get chopped up, especially regular investors who are trying to react in real time. But here's what the mainstream explanation is going to miss. This isn't just silver is bullish or gold is a safe haven. This is a liquidity event, a positioning event, and possibly a confidence event. And if you understand that difference, you'll stop thinking in terms of up or down tomorrow, and you'll start thinking in terms of what kind of market are we in now? Because that determines how you protect yourself. What you're seeing isn't the mainstream explanation. Something bigger is happening beneath the surface. Let me show you the three things happening right now. First, silver is behaving like a market with thin liquidity, meaning when sellers hit the button, there aren't enough real buyers sitting there calmly waiting. So instead of price moving smoothly, it air pockets. 1 minute you're fine, next minute you're down 10%, and then you snap back like nothing happened. That's not because the fundamentals changed every 15 minutes. That's because the paper market is crowded. People are leaning the same way. And when the market moves against them, the exits get very small, very fast. And silver is the perfect metal for this kind of chaos because it's smaller than gold. It's more volatile, it's more sensitive to leverage, and it has this unique split personality, part monetary metal, part industrial metal. So it gets hit from both sides. Second, when you see a move like plus 9 to 10% in a day, you have to assume forced positioning is involved. I'm talking about margin calls, risk managers, dealers cutting exposure, funds getting told, reduce this right now. That kind of forced selling creates the drop, and then the moment the pressure eases, even slightly, you get a violent bounce because the market was temporarily pushed below where it should be. That bounce makes people think, okay, the bottom is in, and sometimes it is. But other times, it's just the second act of the same play, because after the bounce, you often get another shakeout once the market realizes the underlying problem isn't solved. Third, and this one matters for both gold and silver, there's a tug of war happening between official demand and speculative behavior. On one side, you have steady buyers, central banks, long-term allocators, people who don't care about today's candle. They care about the next 5 years. On the other side, you have leveraged trading and momentum chasing, where the same money that buys the top is also the money that gets liquidated on the dip. When those two forces collide, you get exactly what we're seeing: violent drops, violent rebounds, and a whole lot of people convinced the market is rigged because the moves don't feel human. Now, I'm not here to tell you it's a conspiracy. I'm telling you it's a structure problem, and structure problems create price moves that feel unbelievable. So now the question becomes, how do you tell the difference between a healthy rally and a dangerous whipsaw? Here's what they're not showing on CNBC. Smart money moved before the crowd noticed. Let's start with the institutional and positioning side, because that's where these big sudden moves usually begin. In the last couple weeks, the story underneath precious metals hasn't been everyone suddenly loves silver. It's been large pools of capital moving in and out, risk getting repriced, and portfolios trying to decide whether they're in an inflation world, a recession world, or a something breaks world. And when portfolios can't agree on the regime, they don't trade calmly. They swing. Now zoom in on what a whipsaw really is. A whipsaw isn't just volatility. Volatility can be high and still trade in a fairly logical way. A whipsaw is when price travels far enough, fast enough, to force decisions. It forces weak hands to sell. It forces late buyers to buy at the worst moment. It forces sure things to become what just happened. And the reason this is so dangerous is because it changes your behavior. You stop planning, you start reacting. And in metals, reaction is expensive. Now let's talk about the technical reality in plain English. When silver is ripping up 9–10% in a day, that means it probably went from everybody's scared to everybody's chasing in the span of hours. That usually tells you two things. One, the down move was likely exaggerated by forced selling, again, liquidity and leverage. Two, the bounce is real, but it doesn't automatically mean stability has returned. So what levels matter? In a whipsaw regime, there are two zones that act like magnets: the panic zone, where sellers hit the market because they can't take it anymore, and the disbelief zone, where price rebounds to a level that makes people say, no way it holds up here. Right now, Silver around 77 and change is closer to that disbelief zone than the panic zone. That doesn't mean it has to fall. It means you need to treat this as unstable ground. Because in unstable markets, the next move is often designed to hurt the most people. If too many people got short at the lows, the market rips higher to punish shorts. If too many people FOMO'd at the rebound, the market dips again to punish late buyers. It's not personal, it's positioning. And silver, more than almost any mainstream asset, is prone to these positioning storms. Now let's talk fundamentals, the supply and demand story, because this is where most people get misled. A lot of commentators will say, well, silver is up because industrial demand is strong, or silver is down because the economy is weak. That's too simplistic for what we're dealing with. The truth is, silver can have strong long-term demand and still crash in the short term. Because short term is about flows, leverage, and liquidity. Long term is about physical constraints and structural demand. So if you're a regular investor, you have to hold both ideas at once. Yes, silver has a real-world use case in things that matter, energy systems, electronics, and more. But no, the short-term price does not behave like a calm supply and demand textbook. It behaves like a financial instrument that gets whipped around by traders, futures markets, and risk limits. That's why you can see a world where physical buyers step in at lower prices, while paper price collapses anyway, because paper selling is bigger, faster, and sometimes forced. And when you get that mismatch, it creates opportunity, but only if you don't get emotionally hijacked. Now gold. Gold at roughly $49.66, up about 4%, tells me the hard asset bid is still alive. Gold is the monetary confidence metal. It's what people gravitate toward when they're uncertain about policy, currency strength, or the stability of the broader system. And the fact that gold and silver are both moving hard in the same window tells you this is not just a quirky silver story. This is a macro story. And when macro gets involved, the moves tend to be bigger and the narratives get louder. Which brings me to the historical parallel, because we've seen this exact pattern before. History is repeating itself. Back in 2020, we saw an environment where everything felt unstable. Policy uncertainty, frantic repositioning, and markets that didn't behave normally. And in that period, silver was notorious for exactly this kind of action. It would collapse faster than people thought possible, and then rebound so violently it made bears look foolish. The key lesson from that period wasn't silver always goes up. The lesson was, when liquidity disappears, silver doesn't trade like an investment. It trades like a trap. Stage 1 was the shock move, when everyone rushes to reduce risk at the same time. Stage 2 was the snapback, when forced selling exhausts itself and price rebounds because the market temporarily overshot reality. Stage 3 was the narrative war, where every rally gets called the start of the moonshot, and every dip gets called the final collapse, and regular people get pulled into emotional decision-making. And the people who did worst were not the ones who were wrong about silver long-term. They were the ones who had the right thesis, but the wrong positioning. Too much leverage, too little patience, too reactive. And that's the part nobody wants to hear because it's not exciting. But it's how you survive this kind of tape. Now, I want to make this personal. Let's make this personal. Because for most people watching, you're not trading silver futures. You're not trying to scalp 5-minute moves. You're trying to protect purchasing power. You're trying to diversify. You're trying to avoid getting wiped out by the next policy mistake. So here's what this move actually means in real dollars. If silver is up about 9.7% in a day, and you own a modest position, say you've got $10,000 of exposure through whatever vehicle you use, that's about a $970 swing in one day. Now, if you're holding something more aggressive, say a minor or a leveraged product, your swing could be 2 or 3 times that. And that's where this becomes dangerous. Because most people psychologically can't handle random $1,000 swings in a week without changing their plan. And in a whipsaw market, changing your plan is how you hand money to the market. Now flip it. If you don't own silver and you're watching this move, it creates a different kind of pressure. It creates the feeling that you have to do something right now. And that's how people end up buying the rebound instead of buying the opportunity. So the practical takeaway is not be bullish or be bearish. The practical takeaway is respect the regime. If we are in a whipsaw regime, you want to think in probabilities and ranges, not certainty and straight lines. You want to assume the market can overshoot both directions. You want to size positions so that if silver drops 10% tomorrow, you don't panic. Because if you panic, you'll do what most people do. You'll sell weakness, and then you'll watch it rebound without you. And that is the most emotionally expensive way to participate in metals. Now look, the question isn't whether we see more volatility. The math is clear. When a market can move nearly 10% in a day, it is telling you the system is unstable right now. The real question is, are you positioned for what comes next? Because the next phase will answer one big question. Was this rebound a stabilization, meaning the forced selling is done and the market is rebuilding? Or was this rebound just the setup, meaning we still have more liquidation ahead, and the market is luring people back in before the next leg? And I'm going to be honest with you, I don't know which one it is yet. Nobody does with certainty, but you can prepare for both outcomes without gambling. You can respect the levels, you can respect your sizing, you can respect the fact that silver is not a set it and forget it asset in the short term. And you can watch what the bigger players are doing, because when this kind of volatility hits, smart money is already positioning. Now I share updates and deeper breakdowns on social media as conditions change, because in a Whipsaw tape, the story can evolve fast. For those wanting deeper, members-only style analysis and early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the data tells the story. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from, and tell me where you think silver is headed by the end of this month. Do you think we're going back into the 60s? Or do you think this rebound has legs? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video gave you value, comment data over hype, so the algorithm knows you're here for the original. 3, next video drops tomorrow, and I'm covering the one indicator that tends to show up right before these volatility storms calm down or explode again. It's flashing again, and most people aren't even watching it. You won't want to miss it. See you there. See